Brian, I'll turn the floor over to you, and thank you very much for chairing the session.
Yeah, well, it's a pleasure being here today and starting the afternoon session. Well, or I guess we're not starting the afternoon session; we're ending the morning, and we will be beginning the afternoon shortly. And Barry asked me to chair the session a while ago, and the macroeconomic challenges to the supply chain adjustments. It reminded me that I have been working and organizing conferences in the agriculture side in one fashion or another for 55 years.
Wow.
And I've noticed a pattern that has happened, that every 3 to 5 years, someone gets excited about having the macroeconomic side as one of the sessions on the topic. And it goes from having no interest to it to every 3 to 5 years, then suddenly we're in a macroeconomic session. And I'm not sure exactly how, in the past, we always viewed it, how is the macroeconomic side affecting the agriculture and food sector? And now I think we don't know what the question is sort of a dual where how is the macroeconomic side affecting the agriculture side? But we also have the other side is how is the food and agriculture supply chains affecting the macroeconomic side? And it's much more a sort of a equal partnership on the dance floor there between those two topics. And so it's however we look at it, then we have a great guest today, which is perfect for this session. Paul Bingham, a senior executive with S&P Global, and I'm sure we'll learn a lot about S&P Global as one of the really big corporations in a few areas, in the 3 areas that I sort of identify with in terms of who S&P Global is the whole S&P indices side, which we're all familiar with, the S&P 500. But then the global ratings business, including the creditworthiness, and then the market intelligence side, which Paul is a major part of. He's the director of transportation consulting, focusing on supply chain logistics, the freight transportation, and international trade markets. And so I'll turn that over to you, Paul.
Thank you so much, Brian. Really appreciate it. I'm going to do a screen share here if I can get this to work right. This is a talk that's going to try to address, as Brian said, the macroeconomic story, as well as a supply chain perspective around it. So the big picture of this is one that is from all of our economists. First, I get past our page of disclaimers from our lawyers, which we have many of now at S&P. Most importantly, we're not part of the ratings division. They're an independent part of the company, and our forecasts are not integrated or in any way affecting the global debt rating that our brothers and sisters over in that division do. But I'm in a group called Economics and Country Risk within S&P Global Market Intelligence, which is the information, the core of the information business. As Brian mentioned, we have other divisions. We have a Commodities Insights division that has our agriculture economists, our energy economists, and many other industry economists focused on commodity markets. We have a mobility division that does transportation and other motor vehicle equipment. And there's a couple of others in this large information conglomerate now that's formed through the merger of IHS Markit, which includes a publication called the Journal of Commerce, and many other financial businesses and information businesses with Standard & Poor's Corporation out of New York back in March of this year. So this is a new development of being combined as an information company. But the roots of our company on the economic side go back several decades. I worked for a company called DRI McGraw-Hill that was a subsidiary of the publisher of McGraw-Hill that owned Standard & Poor's. So I worked for Standard & Poor's before in the 1990s. They also have incorporated in that Wharton Econometric Forecasting Associates and several other economic forecasting firms that go back all the way to the 1970s in their roots. But collectively, it's a group of economists that do econometric forecasting of models and provide information and databases of time series data primarily for use in market planning and decision making, strategic and tactical operational decision making, both in the public sector and the private sector. So I work with macroeconomists, though I am not one. I primarily a transportation economist focused on freight transport, goods, and international trade. So that's my background. So let me start with this big picture story. We have the global economic picture in this graph, with the real GDP here represented in the green bars, which is our forecast for growth rates, looking all the way back to the history going to the 1990s. For what's going on with the world economy. And I overlaid on that industrial production and real exports to get an idea of the manufactured side of trade, not necessarily agriculture production on the resource side, but representing some significant element of international trade. And then the real exports, which is the total of all production that's exported by countries globally. And the point of going back 30 years here is to show the prior recessionary period, such as in the early 1990s, and then we had a recession in the beginning of the 2000s, and then we had that big financial crisis, global Great Recession in 2008, 2009. And then we had this very short sort of first half of 2020 recession in the world, certainly North America and Canada, the United States, with a very strong recovery that followed that with the developed country fiscal stimulus. And now our forecast is for recession for 2023, but you'll note the lines there, none of them are negative. And that the reason for that is our company interprets growth in the world economy of less than 2% as a recession. The potential growth is much higher than that. And the reason for that is we've determined that that level of growth is clearly recessionary in terms of suppressed growth in the aggregate around the world, demand and production output all being below anywhere near the potential. So that if we reach that level below 2%, and we're forecasting 1.5% growth for the world economy as a whole in 2023. And in conjunction with that, further reductions we've already seen in 2022 of both industrial production and export trade, coming back from that boom year of 2021, coming out of the pandemic recession when we had pent up demand and we had supply chain issues around the world that resulted in the congestion and problems with performance and increasing transportation rates that are only now subsiding and slowly. The reason for this recession is primarily the issues around inflation that have cropped up. And I'm going to talk some more about that shortly. But primarily central banks are trying to fight that inflation by raising interest rates and purposely, intentionally trying to slow the economies. That's happening with the Bank of Canada, and it's happening in the United States with the Federal Reserve Board, and on around the developed world in 2023. Fortunately for the world economy, the advanced countries, the developed countries are not the sole determinant of growth in 2023. And in fact, there's a little bit of residual demand that's a little greater coming from emerging markets in our baseline forecast for 2023, as some of those economies have not gone through quite the same range of boom and bust related to the pandemic without as much fiscal stimulus, for example. And with some resource export demand continuing, especially, for example, for energy commodities that help support some of the regions that end up being emerging markets, for example, in the Middle East. So in the aggregate, you have the world economy growing at 1.5%, but the advanced countries are basically stalled out, almost no growth. And in fact, that's our forecast for Canada. But let me get first, before I get to that, let me go through breaking the world into 8 regions, where North America is Canada, United States, and Mexico, and then the rest of the hemisphere is other Americas, our traditional trade partners in Western Europe, and then the rest of Central and Eastern Europe as emerging Europe, the Middle East and North Africa, and then the rest of the African continent and sub-Saharan Africa, traditional Asian trade partner Japan, and then the entirety of the rest of the Asia Pacific region. Grouped together, and then for each of those showing the annual gross domestic product percent change going back to 2020, so the year of the pandemic recession, where every region contracted in sync, though to varying degrees. And obviously North America did suffer that short, sharp recession in the beginning of 2020, but other regions such as the rest of the hemisphere and Western Europe had an even deeper recession. And then all of the regions had a recovery in 2021 with varying levels of strength to those recoveries, led by the rest of this hemisphere, and then Asia and North America and emerging Europe. But then that growth didn't all continue into this year, where we saw the Russian invasion of Ukraine in February result in the European economies actually already turning into recession. And then some divergent growth tied to export energy commodities, and for some other reasons that I'll touch on a little bit, that we've seen some more divergence. And then from a perspective of the forecast for 2023, greater divergence in some of the growth rates, where in North America, we are essentially flat with no growth at an annual basis for the year, and some moderate growth in the rest of the hemisphere. But in Europe, actually contraction, both in Western and Eastern Central Europe. At the same time, the Middle East and North Africa are still benefiting from, still high energy prices for their exports. And that is also still benefiting some of the exporting countries in the rest of Africa. Japan is seeing a slower growth, but not quite on the same pattern, where they don't have as far to fall because they haven't come up as strongly prior to this, without the same level of growth that was seen in the Americas in the recovery in 2021. And then in the rest of Asia, actually some resilient economies, not so much China, which is suffering a bit, but is still going to grow. Our forecast for China is still 2% growth GDP for 2023. But some of the other regions in Southeast Asian countries still doing better, though not tremendously, not anywhere near the growth that they had just a year ago in 2023. So let me continue on from that to talk specifically about Canada. The path of growth has been one of growth that had in the mid teens specifically in 2017 had reached the high of 3% growth, which was the strongest year of the recovery since the Great Recession. But then with the pandemic in 2020, a contraction that was almost was over 5%, very strong contraction in the first half of the year, with a recovery that started that then reached substantial, really boom conditions, almost unprecedented level of growth that was achieved through the year for 2021. And then this year we started in Canada very strong growth coming into the year with tremendous demand, but then it slowed later in the year, such that as we head from the fourth quarter into the first quarter of 2023, we're actually expecting contraction. And if I had this mapped quarterly, you'd actually see we're forecasting a decline in Canadian GDP in the first two quarters, and then beginnings of a recovery, a weak one, at the end of the year in the second half, such that the net for the year on an annual basis is going to be zero in our baseline forecast. And then the recovery continues in 2024, but it's a weak one, not anywhere near the kind of rebound we had out of the pandemic recession in 2021. So that supply chains may not be stressed as much, but there's also some not kind of weak opportunities for recovery in terms of making up for the lack of business in 2023. And that continues if I extended this out, the time series for a couple more years. This will be a weak recovery period to match the weak recession in 2023. So having the economy not whipsawed as much on either side in terms of output or growth, and we'll talk about that in terms of trade. If we look at the United States, a similar pattern. Here in this graph, it's quarter by quarter. So a similar period with the big decline and the Great Recession back in 2008, 2009 with a 6-quarter long recession. Similar to Canada, the shorter recession just at the beginning of 2020. And then this recovery period that continued with very strong growth initially, and then moderation. And in fact, in the United States, a contraction in the first 2 quarters of 2022. But not declared a recession, at least by the U.S. National Bureau of Economic Research, that has a business cycle dating committee that determines such things, and said that the other factors, such as the strength of employment markets and wage acceleration and so forth, had kept the economy out of recession for the year. But we don't, our forecast is that isn't continued. The decline following a similar pattern in the first half of 2023 compared to 2022 will result in it being determined to have been a recession, with unemployment increasing, consumer expenditures declining, and total output declining more in the first quarter of 2023 than they did in the United States in 2022. And then, as in Canada, a somewhat muted recovery in terms of the pace of growth coming out of the recession, starting in the second half of the year and then continuing into 2024. So let's look at the inflation picture, which is really partly what's behind the recession that's coming. On this slide, I have the point that the inflation reached a level which was a 27-year high, and this is a global measure of consumer prices on the graph on the left in the purple, and even more dramatic, the more volatile producer price index in the blue, all measured in percentage change against the baseline, and then contrasted there again to the real GDP in the green bars for putting it in perspective, and that enormous spike, a decades-long high in inflation globally that's affected, in Canada there in the table on the right, this year we're forecasting by the end of the year will come in at 6.8%, double the rate of inflation from just last year, in and of itself being relatively high, even higher than that in the United States. So the central banks, for good reason, being very concerned about if inflation were to get a hold of the economy on a longer term basis and result in risks of stagflation or other more serious damage to the economy, have turned to a singular focus through raising interest rates successively in an attempt to slow the economy deliberately, to try to get these wage and price increases down. And there's already some signs that it's working. Initially we've come down off the peaks earlier in 2022, but we've got a ways to go. We're nowhere near the targets that either the Bank of Canada has for Canada or the Federal Reserve Board in the United States. And if we look across the world at the other countries, we're saying that the 2022 overall consumer price growth will still end up at 7.7 and slowing down, but it will not have slowed down enough in 2023 to actually account for or to get to the point where the central banks will completely reverse monetary policy and significantly reduce interest rates by the end of 2023. In fact, for example, in the United States, we're forecasting an additional 2 increases in the discount rate, and I believe our forecast is also for additional increases from Bank of Canada before they're done, before they determine that they've gotten ahead of inflation sufficiently to stop increasing interest rates, which have passed through the economy enormously. Other countries are not all in sync with that. It depends on which country you're in. In some countries like the United Kingdom, they're even worse off in terms of inflation when we translate some of the dollar trade and the impacts they've had to pay for dollarized commodities. Or Japan, which has had an increase in inflation, but still much lower than we see in North America. And some of the developing countries obviously have had even higher inflation, and then the extreme case probably the data isn't very good for, but Russia, much higher, and we could go on with others where inflation has really been running rampant in 2022, and for that reason, the central banks are taking unprecedented steps in terms of the pace and the volume of the increases they're doing. So if we look at Canada's inflation, our forecast, it's going to decrease in 2023 from the pace it was at, measured, and this is measured at the the beginning of the year basis from where we were, but still over 2%, and then following to come down further as we get into 2024. This is an annual frequency, just shows how much it had increased from the base in the pandemic, when initially we had almost deflation with very low inflation initially in the beginning of 2020. The Canadian dollar exchange rate forecast for 2023 show a continuation of the pattern we saw in 2022, which was a weakening of the Canadian dollar versus the US dollar. If we looked at this on a trade weighted basis, we'd see some similar shifts. But that's had some implications for Canadian exporters facing, a weaker dollar Canadian dollar has obviously benefited them in terms of being price competitive on world markets, trying to sell against other competitors. At the same time, that's affected the ability of importers to absorb, inflation through the import prices. Unfortunately, we're forecasting that will reverse in 2023, and there'll be some moderation more towards the trend. Again, especially as the U.S. dollar and the U.S. Federal Reserve Board getting ahead of the Bank of Canada in terms of the interest rates and so forth will ease. Also, some of that, there's an element of sort of the flight to safety of the U.S. dollar, which affected the U.S. dollar exchange rate against the Canadian dollar and other currencies in 2022, that we see easing as we get further on away from the immediacy that was there around the initial Russian invasion of Ukraine. So if we look at the impacts on trade, specifically, Canadian import growth in 2023, we have falling quite substantially from the 8% growth that we saw, almost 8% growth in 2021, and then our forecast for 2022, which was for growth actually over 8% in total imports, falling to just 1% as demand goes away in 2023. Also, the exports, which had increased this year by well over 3%, at least in our estimation by the time we get to the end of the month, we see falling in 2023 with a weakening of demand in those trade partner economies. However, that fall off on the export side is much less than we see on the import side, which helps the trade balance for Canada, and also helps the exporters. So especially in agriculture markets where Canada is a big exporter, there are some bright spots in terms of some sustained demand, especially in emerging markets for some of those export commodities. So it's not all a doom and gloom story in terms of trade entirely, though it's still at a slower pace than we saw the growth in 2022. And the recovery that we see is actually muted. It's in fact, the growth rate on the export side, we have forecasting to even be slightly slower in 2024. While on the import side, it recovers a little bit, though nowhere near the pace that we saw in the last 2 years or this year for the total of Canadian imports, as the Canadian economy returns towards a slow growth period and consumers and businesses start to import more. And I have another slide here I wanted to cover specifically at the end, which is based on our Global Trade Atlas forecasting service that we have that forecasts world trade, not just from macroeconomic terms, but this is a bottom-up forecasting system that is commodity by commodity, trade partner country by trade partner country in value and volume terms. So this graph is actually not in dollar terms. This is in metric tonnage. So this is a total view of the physical quantity of commodity trade, looking back at the period quarter by quarter to before the recession in 2019, and then our forecast through the end of 2024. And you can see the pattern within the initial stages in 2020 of the recession, the decline, absolute decline in the movement of commodities when we shut down economies. And that the gray bars at the bottom there mapped against the right axis is a year-over-year percent change, but measured at a quarter-by-quarter basis. So you can see the extremes that we suffered in the quarter-by-quarter with that sharp drop-off in trade in that first part of 2020, especially by the second quarter when we really had orders canceled and volumes not moving. But then that recovery that was really quite dramatic in tonnage from that base just in the first half of 2020 up to the levels that we reached relatively quickly by the end of 2021. And then how that was sustained growth into the beginning of the first half of this year, but that since then, subsequently, from in the aggregate for the world, we've seen actually a decline in total trade, and that's even as some trades have increased due to the disruptions to supply of commodities like energy that have happened, especially in Europe with the Ukraine invasion from Russia. But I call your attention to our forecast for the recession as we move into 2023 in the first quarter. We actually are forecasting that the world trade decline in the global recession will actually bottom out in the first quarter. So that recovery begins from a global perspective and gets us back over the recent peak that we saw just in 2022 by the end of 2023. So that's actually an optimistic view in some respects in terms of the physical trade demand that will return. The growth is not anywhere near as fast as we saw, say, even in 2021 on an annual or quarter over quarter basis, but it returns us more towards a trend of relatively slow growth in trade. There is we're forecasting a short setback a little bit in the beginning of 2024. I believe related to some assumptions around inventories and how the recoveries play out in some other regions that will happen with a lag to North America. But then as we move towards the end of 2024, seeing growth that is back on the tread path as we head on out into 2025 and beyond. And the point of that is there's some resilience based and built into world trade. And we expect that the North American producers and the North American consumers and businesses will benefit and participate in that. But that we've still got to go through this disruption in 2023. So that's my prepared remarks. I wanted to leave some time for Q&A, and Brian, I'm not sure how best to handle that, but I'm gonna stop sharing my slides, and then we can just work from the screen of the video for each of us as they participate, and I'll stay on microphone to either hear people or something that's in a chat box. I haven't looked to see if we have any, if you're using a comment screen or not today, or if you're going to just take them one-on-one. Brian, you're on mute.
Yeah, apologies. I have a couple comments here, but I think they're from Barry. And
Okay.
Brian, in case you need a question while others are responding to the chat, the rising interest rates are affecting house prices and presumably the stock market. Does a loss of wealth from an impact on the consumer's spending, how does that affect the recovery?
Yeah, great question. And absolutely the answer is yes. It's already happened in Canada, well, in other countries as well. But as you've had this housing market turn down from the boom that we've experienced as the interest rates have increased and mortgage costs are being elevated. As interest rates increase, certain households are no longer able to qualify for mortgages of the size that they were able to get just 6 or 9 months ago. That downturn then permutes as the housing demand starts to erode. The housing construction is backing off. Then the supply chains that feed that are packed. The sale of commodities such as furniture and appliances and home furnishings decline as well as the housing market turns down further. So it permutes itself through the economy and affects employment in those sectors. And certainly, the expectation is there will be downturns in actual selling prices of homes further in various markets across Canada, and won't see recovery from that until we get to where interest rates and mortgage rates are to come down again, sort of after the Bank of Canada is confident that they've got inflation under control. So that's not, and I don't know that we're there with the consensus, some other macroeconomists for the Canadian economy, but I believe we're saying that that's going to take a little bit longer into 2024 to have those kind of markets start to see the real signs of recovery yet. That is definitely a factor. And then on the question of the wealth effect, that is absolutely an issue for households that are taken into consideration and our income and wealth holding level in society that influences purchasing decisions. As the value of their home may be an actual cost, they're not in the markets to be interested in selling it. Just the idea that the value has gone down. And if you're holding equities in the markets that have also gone down in value, that is clearly having an impact already, and will have a bigger impact as time goes on. There's a lag time effect to spending behavior, and we're anticipating to play out as we get 2020. Consumers look at, say, a purchase of a new automobile or some other major acquisition. Well, maybe they're going to wait to see if markets recovery, or if they're worried about their job together. in terms of the intended part of what the Bank of Canada is doing, trying to slow the economy.
Yeah, there's a question here from Mary Jane.
To get those inflationary changes down. Yeah.
That you had indicated a recovery when the demand slows, and there's a group of Canadian economists who talk about this being a supply-driven side. Can you comment on which you see this current downturn? Is it primarily demand-driven or supply-driven?
But that's a very important question and a very important point. So the recession we had in the pandemic in 2020 was partly, there was a demand element to it, but largely the problems we had was a supply side. When you shut down fast, you had no good things, you couldn't even produce or deliver them for sale. We've worked through that supply issues by and large at this point. There's still some supply chain disruption and unavailability in certain markets. Motor vehicles is one where there's still some pent up demand, but this is much more so a demand-driven recession. Intentionally so on the part of central banks, raising the cost of capital in the economy, and it's really being then therefore ultimately this is the demand-driven recession, and the recovery comes when demand starts to come back, when the interest rates policy is ended to try to stop increasing interest rates, to ease monetary policy, to ease credit conditions, and then allow consumers and businesses to be able to pursue more spending activities and therefore see a recovery in demand. That's the character of this recession.
You know, one of the interesting points you made was you sort of are redefining what a recession is. And I was wondering, how far is your definition of what a recession is from the previous definition of a soft landing?
Well, I think we might call what we're forecasting for the United States and Canada a soft landing. I think sometimes we're hesitant to use that phrase because for those that lose their jobs or businesses that go into bankruptcy through, being overextended, it's not soft for them. There's still elements of the economy that are hurt, but the softness here is that we're not actually going to have a full year contraction of the economy, shrinking more significantly. So it's one more of semantics almost, and terminology around what, as the economists, we're really just looking at the numbers, and then the qualitative description of those numbers is somewhat arbitrary. It's how much of a decline in growth or lack of growth at all, which is what the baseline forecast for Canada is, that we're going to end up with the value of the economy of Canada at the end of 2023 where we began it. As opposed to potential for the economy, which would be for growth, that we're not going to achieve. And that's the so the definition for recession, I think we leave to the true academics that do business cycle dating. But the argument that we have, and one is really asking other macroeconomists, is that it's more than just purely a GDP metric. That there's some conventional wisdom that you have 2 quarters in a row of a contraction of GDP that qualifies as a recession in a country. And we're saying there's more to it than that. You need to look at things like what has happened to employment, what has happened to wages and prices, to consumption. And in fact, in the United States, that business cycle dating committee of the National Bureau of Economic Research is very explicit about that they take other factors into consideration as a whole before they determine after the fact, in some cases quite a bit after the fact, that they determined that was a recession. And our conventional wisdom around a global recession has been that we have 2% threshold, was an acknowledgement that that an actual contraction in the global economy would be a more severe recession for the world, because the potential growth for the world economy is faster than, say, what is achievable for the more advanced developed economies like Canada, the United States, where 2% growth might be considered somewhat healthy, but for the world, that's sort of the bare minimum when you have potential growth of output that's greater than that, with growing population, faster growing economies, with adoptions of technology. Yeah, go ahead.
One question from Chris Ferris is sort of a fine tuning of what you were saying. Other than the real estate sector, what are the sectors that you see are really interest rate sensitive as we go into this possible recession?
Oh, the others ones that primarily are durable goods manufacturing. So, eventually the automotive industry, the manufacturing of appliances, and then in the business sectors, the suppliers to business of machine tools and equipment, they will suffer as businesses contract with reduced capital expenditures in the face of softening demand and sales and higher capital costs, where the cost to afford that equipment in an inflationary environment when you have to pay higher interest rates if you're arranging for a lease and so forth. So the manufacturing sectors. And then there are sectors that are going to see some reduction in demand, not so much on the resource commodity side, but on even some of the extractive resources as some of the prices come down. Inflation is moderated, and some of the potential customers for those aren't willing to pay as much. You can have some softness in sales. So some of that's reflected in the trade forecast, where there'll still be a growth in trade, but at a slower pace. So some of the expansion will be reduced for some of the exporters that have been, enjoying potentials for faster growth in trade the last 2 years out of the pandemic recession.
I can't really miss the opportunity of asking you a really long-term question. I have for a long time, since traveling around Africa in the early 70s, been very much an Africa watcher. Is Africa the biggest challenge that the world has to face over the next 50 years?
Well, that's a question I don't know that I can claim this is the single biggest challenge over 50 years, but clearly it's one that has been on the horizon for economists for decades, whether they're development economists at the World Bank or just macroeconomists trying to understand the potential for development and growth in the regions of the world. We looked at, if we go back several decades, we looked at how Asia developed from being, much poorer, much less developed region with really only, Japan and then the, Taiwan and Korea and so forth, South Korea, and subsequent growth over the decades from, the last 40 years. That potential for growth is still there in Africa. If we look at the populations, the ability for them, if they can have stability in their governments, it's almost sort of a geopolitical question of can you achieve in society stable enough conditions to allow for investment and growth, that there's tremendous potential in Africa. And eventually you could look at Africa supplanting some parts of Asia as the world's manufacturing floor. Where would you eventually end up with textile production that's labor intensive? There's there are pockets of that already in parts of Africa. You've had enormous investment by some countries, including China, in resource extractive development in Africa. So there's a lot of very long-term potential. The challenge remains, though, can you have a political environment stable enough to allow for the potential to be achieved? Can you have
especially in Nigeria. Now, Barry has a question here in terms of, does the S&P analysis take into account, my screen just changed, take into account, Barry, maybe you want to take this one over in terms of.
Sure, it's just a question of demographic changes. We've seen what we call a great recession happening, or great retirement happening because of the accelerated by the pandemic. Is the S&P forecast taking that into consideration?
Yes, very much so. And in the long term, that's a very important point. I mean, Canada faces that challenge with how you manage immigration to sustain your population. The United States has seen a downshift in the pandemic, which is not likely to fully recover in terms of the population. And if you don't have population growth, you look at a future of a country like Japan with a shrinking population, a shrinking workforce, and enormous challenges with an aging, greater percentage every year of a retired population. And ultimately, China faces that with their one-child policy. Mainland China is facing a population that's aging faster than they're going to be rich. And that's an enormous challenges. They look forward to a demographic shift that's enormous as their population ages and becomes much more of a challenge in the future. And there's other countries in Western Europe, similarly, like Italy, that is facing a population decline. So it's really a question for those advanced economies of can you continue to increase productivity through investment in automation, information technology, to allow your economy to continue to grow with a population and a workforce that's not grow like it had several decades ago, in conjunction with immigration policy that allows for expansion of your population that is not native born, because your birth rates are so low that you don't have the ability to grow as fast purely based without immigration. And that certainly faces Canada and faces many of the other developed countries. So Barry, a fantastic question and an important one long term in terms of potential economic growth for all the developed countries.
I imagine we're running out of time, Barry, but there's another question here. I'll just quickly
We'll allow one more question and go forward. Sure.
That
Sure.
MSC has spent billions to acquire terminals in West Africa, which that should improve logistics. I guess that was more a comment, I think, than a question. There's another question here. I'm seeing an increasing number of people who say that returning to the 2% inflation target might require an unemployment rate above 6%. If not higher in the United States. Do you think there's any truth in that?
Well, I can tell you our baseline forecast is close to that, but not that high. I think our current peak unemployment rate is 5.4%. So substantial increases in the United States unemployment rate compared to where it has been at almost near record lows. So that is a significant element of the pain that the chairman of the Federal Reserve Board, Powell, has used to describe what's ahead if inflation doesn't come down more quickly. And our baseline forecast is that's what we're going to reach, higher unemployment and all the pain that goes with that in terms of lower spending and the implications from having that many more unemployed, the burden on the government in terms of support programs and so forth. And that's likely to be a similar pattern with parallel rates in other developed countries. Certainly in Canada, you'll expect to see some reductions in employment as the economy weakens in the recession. So
and
that's also an important, yeah.
As perhaps a summary question, what are the risks that we get a severe recession versus a mild one? It's sort of lurking in the back of all our minds, I think.
Yeah, thank you for that. Our alternative forecast to the baseline, the one that has the greatest probability, is the pessimistic scenario, and that is for some further disruptions to the world economy, to either raise energy costs further, for example, have further disruptions to trade, a loss of business confidence or consumer confidence that's greater than what we've already seen in developed economies, such that the downturn in spending could be more severe. If bubbles burst in equity markets, that could happen even in China, where they have already a problem with their own housing market. You could see a downturn that's deeper and longer than what the current forecast is. And there are many potentially contributing factors to that. It could be behavior of OPEC in terms of what they choose to do in terms of further reductions in output. If something more severe happens between Russia and Ukraine that impacts Western Europe even more than it already has severely, and so forth, there's an enormous number of risks right now. We have mainland China threatening about Taiwan. There's many things that could go wrong to make that baseline outlook prove to be too optimistic in terms of what we actually go through in the next year or two.
Well, I think we'll have to turn things back to Barry, and thank you very much, Paul, for being with us. And
yes, thank you for including me. I really appreciate the opportunity today, to Barry and Brian, for this session. And if any of you want to follow up, I'm sure through Barry you can reach my contact information, and I'm going to make my presentation available through Barry if he wants to do that subsequently as well.
Thank you very much.
Thank you very much.
Thank you much.
Paul,
bye
Brian,
now. Yep. Bye-bye.
And we really appreciate you taking the time, Paul, from the work you're doing now and losing part of your conference you're involved to join with us and being part of ours. And your last comments were a wonderful segue into the next session, where we're going to look at trade and armed conflicts. So thank you again very much for your presentation, and we really appreciate it. Thank you, Brian, as well.